This last complete module of the course deals with the accounting for income taxes. It's definitely a topic with a lot of brand new material for you, but by the end of the unit, students often have great confidence in their learning, and I'm excited to dive in with you. We're going to start by introducing the idea that financial accounting and taxation are related but separate systems of reporting. For instance, let's take an income statement. You're familiar with the general setup, where we're going to start with sales revenue, subtract out a variety of expenses like cost of goods sold, operating expenses, and other non-operating items. Then, before we get to bottom line profitability, we report earnings before taxes. And in this unit, I'm going to refer to this blue line item interchangeably as book income or pre-tax accounting income. So remember those terms. Then what remains is subtracting out our income tax expense to arrive at net income. Now let's consider a company's tax return, which is going to be very similar in spirit to an income statement. But now our audience is not providers of capital, it's government authorities. Still, we start with gross income, an analogy to sales revenue, the total inflows of resources from providing goods or services to customers. And we then reduce this by any relevant deductible expenses. Again, they're going to be similar to the items reported on the income statement. And after making those deductions from our gross income, we arrive at taxable income, which is analogous to our financial accounting earnings before taxes. The main idea that we're going to be exploring is the fact that these numbers are often different. So we'll be learning about what contributes to these differences and how they are factored into the calculation of income tax expense. So we're going to get real foundational and talk big picture about why earnings before taxes and taxable income are reported at different amounts. To be clear, these differences arise from both the revenue and expense side of the equation. So if we're asking ourselves why these numbers are different, it all comes down to the differing objectives of financial reporting and tax authorities. And you should already know the objective of financial reporting. We've covered it several times throughout the course. Going back to the conceptual framework, the objective of financial accounting is to provide decision-useful information to providers of capital. We're trying to provide them with information that accurately captures economic reality and is relevant to their investment decisions. When we design financial reporting standards, we keep this objective paramount in our minds. But what are government authorities trying to achieve with taxation? Taxes provide two important aims. First, to raise revenues to pay for government projects. But importantly, tax policy is also designed with taxpayer behavior in mind. Governments can try to influence, either incentivize or discourage, actions made by individuals, households, and corporations. So this is an important first thing to keep in mind. The objectives and conceptual framework that FASB brings to the table when designing financial accounting standards are simply not the same thing we have in mind when we enact tax policy. Now, the primary source of discrepancies between financial accounting standards and tax law are called temporary differences. Essentially, this is a matter of when accounting standards and tax rules will ultimately recognize the same levels of income and expenses. It simply happens in different periods. Another way of putting this is that it's not whether a given transaction is taxable or deductible, but when. And as we'll see with numeric examples later, these will originate in one period and will reverse in one or more subsequent periods. And these temporary differences give rise to two new accounts we've not yet talked about, and they are known as DTLs and DTAs. Let's start with DTLs, which stand for Deferred Tax Liabilities. These result from temporary differences that allow a company to delay paying taxes until a future period for activities reported in today's income statement. In other words, these would reflect revenues that get recognized today for financial reporting, but won't be taxed until later. Alternatively, they reflect expenses that are able to be deducted on today's tax return, but will not be fully expensed on the income statement until the future. Collectively, DTLs are referred to as reflecting future taxable amounts. On the flip side, deferred tax assets, or DTAs, exist when a company is paying more in taxes today above and beyond what the current period income statement would have otherwise indicated. Again, using the reverse of what we mentioned with DTLs, these would reflect income generating activities that are taxed today but are not yet recognized as revenues on the income statement. They can also reflect expenses that are recognized on the income statement but are not yet deductible on this period's tax return. And generally, we refer to DTAs as reflecting future deductible amounts. I'm going to go through a bunch of examples to help illustrate what these look like in terms of concrete transactions. I don't expect you to memorize these per se, but you certainly can if it helps you. Overall, you just want to start building that intuition of how to analyze any given transaction that comes your way and think through whether it represents future taxable or deductible amounts. And I'm going to go through this with this 2x2 matrix where we can see that temporary differences can stem from both revenues or expenses. How they're handled depends on whether they're reported on the income statement today, but the tax return later, or vice versa. I'll start in that top left quadrant by talking about installment sales of property. Picture a car dealership that finances the sale of a vehicle to a customer. For financial reporting purposes, once the dealer has provided the car to the customer, the company has satisfied its performance obligation, and it gets to recognize the full revenue for that sale. However, the contract will be paid in installments per some financing agreement. For tax reporting, the company will only report as a part of taxable income the cash receipts from those installment payments as they are made. In this same category, we've got unrealized gains from short-term investments. If a company holds trading securities and they go up in value, that will result in a gain being properly recognized on the income statement, increasing reported net income for the period. But for tax purposes, gains from investments like these are not taxed until the investment is actually sold and the gain is realized. In both of these situations, the revenues and gains reported on the income statement will be greater than those reported on the tax return. It's income not taxed today, but will be in the future. Hence, these transactions give rise to deferred tax liabilities. Moving to the right, let's consider expenses that are on the income statement now, but will be deducted on the tax return later. This can involve unrealized losses from short-term investments, kind of the opposite of what we just talked about. But more importantly, estimated expenses come into play here. Picture something like bad debt expense, which we've emphasized from an accrual accounting perspective is important information to disclose to financial statement users, so they have timely information about credit losses. We don't know exactly which accounts will be written off in the future, but we estimate the total expense due to uncollectible accounts. While these serve to reduce net income for the period, they cannot be deducted on the tax return until the accounts are actually written off, closer to a cash basis accounting technique. So bad debt expense, along with many other types of estimated expenses, reflect deductions that we cannot take today, but they will show up on a future tax return. Thus, they give rise to deferred tax assets. Let's keep going now and consider deferred revenue, which reflects cash collected in advance of satisfying performance obligations. And you can bet your boots, the IRS is always happy to tax that cash as you receive it. But you already know that for financial reporting, it will not be recognized as revenue on the income statement. So, in the future, we'll be able to recognize revenue that we will not be taxed on. Thus, it is a deferred tax asset. And then to complete this illustration, I want to focus on the number one most important source of deferred taxes, which comes in the form of accelerated depreciation. While we know that nearly everybody is using straight-line depreciation for financial reporting, companies will often elect to use a different timeline to depreciate fixed assets for tax purposes. And by taking larger deductions for depreciation today, the company will end up with a situation in the future where the straight-line depreciation expense for a given asset will be larger than what is able to be deducted on a future tax return. In other words, this is a major source of deferred tax liabilities. We'll also do some examples later that deal with prepaid expenses, And overall, this is a pretty good start with learning to recognize the types of transactions that produce temporary differences resulting in DTAs and DTLs. Now, to be clear, I'm not ever going to require you to be an expert with the tax treatment for any given transaction. While I will hold you responsible for anything in the financial accounting space that's been covered in this class, I will always be explicit and tell you the tax treatment of any transaction that will show up on homework or an exam. And if I can give you one last tool to help you classify these transactions, let me provide the following rule of thumb. For any given transaction, I want you to ask yourself whether, relative to book or pre-tax accounting income, will today's transaction result in higher deductible expenses, lower taxable income, or as one of my former students put it, paying fewer taxes today but more in the future? If those are true, this indicates that the transaction will result in a deferred tax liability. On the other end, if today's transaction results in lower deductible expenses or higher taxable income relative to book income, or in other words, if it feels like we're paying more in taxes today but will pay fewer in the future, this will result in a deferred tax asset. Mastering these classifications is a critical first step in handling the accounting for income taxes.